Chapter name is non-fund based credit facility. These are the topic which we are going to study: objective, introduction, non-fund based limit, letter of credit, what are the risks associated with the opening import LC, assessment of letter of credit limit, buyer's credit, supplier credit, bill purchase discounting, bank guarantee, and co-acceptance facility. All these we will cover bit by bit. So let's get started with our very first topic, which is the non-fund based limit. So basically, you know that what do you mean by non-fund based limit? In simple word, these are the bank facility where the bank do not give cash immediately, right? The keyword is no immediate outflow of the fund. Bank do not give cash immediately, right? So when the limit is sanctioned, no money goes out of the bank at that moment, right? But the bank still give it a promise or guarantee on the behalf of the customer. So at the time of sanctioning the loan, no immediate outflow of fund occur, but possible, but bank still give it promise or guarantee. Yes, bank give promise or bank give guarantee. Okay, on the behalf of the customer, bank give promise or guarantee on the behalf of the customer. Okay, so the key idea is very important, that bank credibility replaces the customer credibility. This is a very important thing. Bank credit worthiness substitute the borrower credibility, right? So this means the seller or third party trusts the bank, not the customer. The bank say, if my customer fail, I will pay, right? That is what the bank say, that if my customer fail, then I will pay. So remember this rule: no fund outflow now, but possible fund outflow in the future. No fund outflow initially, but possible future fund exposure. This is the key point to remember. For example, suppose a bank issue letter of credit for buying the goods. The bank does not pay immediately. Payment happen only if the conditions are met later, right? So suppose a bank issues a letter of credit for goods purchase or buying the goods. The bank does not pay immediately. Payment happen only if the conditions are met later, right? So that is the point. So credit worthiness substitute the borrower credibility. No fund outflow initially, possible future fund exposure. That is the point. Now the point is, quasi credit facility. See, when I say quasi, what is the meaning of this term quasi? Quasi means, almost. Quasi means almost. Please understand. Quasi means almost. So these are, almost like loan, but not exactly loan at the beginning. Almost like loan, but they are not exactly loan, right? So simple meaning is that, these are non-fund facility. These are called non-fund facility, right? But they can turn into fund-based exposure. They may convert into fund-based exposure. Even though bank has not paid money, risk already exists. Risk already exists because yet bank has not paid money, right? Risk exists. So the golden rule is that if borrower default, bank pay from its own fund. Default by borrower, bank will pay from its own fund. Let me give you an example. Suppose a bank issue a bank guarantee, and the customer failed to complete the contract. So bank have to pay the guaranteed amount. Bank pay under bank guarantee. Bank issues the bank guarantee and customer failed to complete the contract. So bank have to pay the guaranteed amount. That's why these are called quasi credit facility. If you look at the types of non-fund based facility, so what are the main types of non-fund based facility? The first one is a letter of credit. Other is the bills, bank guarantee, and the third one is called acceptance. So all these have a common purpose, that assuming payment or performance, no immediate fund flow. What is the common purpose of all these instruments? Assuming payment or performance and no immediate fund flow. For example, take the case of BG. Suppose BG is issued for the execution of a contract. Suppose BG is issued for the execution of contract. It assured the other party that bank will pay if the customer fail. Okay, bank assured that I will pay you if the customer fail. So the master tip is that no disbursement does not mean there is no risk. Even though the bank has not paid anything today, non-fund limit are always potential for fund exposure, right? Always potential fund exposure is there. So let's revise with the quick formula. First of all, non-fund limit, remember, no immediate outflow of fund. Default happen, then bank step in with fund. So remember, memory trick: LCBG, first non and latter fund. Means first stage non-fund and later it become fund-based exposure. Now let's apply the concept to some MCQs. Question number 1. Which facility does not provide immediate disbursement of fund? Cash credit, term loan, letter of credit, overdraft. So out of these options they have given, letter of credit, they do not involve immediate disbursement. C is correct. Next question. Why are non-fund based limit called quasi credit facility? No margin is required. Bank earn no income. They may convert into fund exposure. No risk is involved. So non-fund based limit are called quasi credit facility because they may convert into fund exposure. Option C is correct, right? They may later convert into fund exposure. In the case of default, bank must pay, creating fund exposure. So I hope till now everything is clear. Why bank like non-fund based limit? The answer is that bank prefer this facility because no immediate deployment of fund, margin money is collected, commission earned, bank earned commission income, and more business opportunity, operationally convenient. Now let's talk about the advantage of non-fund based limit to the borrower. So friends, why do borrower like non-fund based limit? So the answer is very simple. They are cheaper and they need less cash. Due to two reasons. First of all, they are cheaper. Second reason is that they need less cash. Because of these two reasons, borrower like the non-fund based limit. In fund based limit like cash, credit or term loan, what happen? You borrow money, you pay interest, you use your own fund also. Right? Take the case of CC. Take the case of term loan. What happen? You borrow money, right, and you pay interest also. Obviously you have to pay interest, and you use your own fund. Some margin has to be given, right? But in non-fund based facility, you don't take actual cash, you only deposit a small margin, and bank give full credit support, right? So instead of taking a loan, the customer take a BG by depositing only a margin money. Cost is low, benefit is high. This is benefit from the customer point of view, right? So what is the alternative solution, alternative source of credit? Yes, now think of the non-fund based limit as an alternative way of getting the credit. You can think of it, it is just an alternative source of credit, right? Non-fund based limit. So you are not borrowing money, but still you get the credit support. Yes, that's why this is called alternative source of fund, because you are not borrowing money, but you get credit support. How? The bank give it assurance based on your margin money, because you are getting the bank assurance based on the margin money, right? So bank give it assurance based on your margin money. So remember this formula: margin money plus bank assurance is equal to credit availability. Suppose, for example, a buyer uses a letter of credit to purchase goods instead of paying cash immediately. So business happen without actual borrowing. Suppose there is a buyer, right? What happened? The buyer uses letter of credit to purchase goods. The buyer uses letter of credit to purchase goods instead of paying cash immediately, right? So business happened without actual borrowing. They have not borrowed, but buyer has issued letter of credit to purchase goods instead of paying cash immediately. So the business happened without actual borrowing. Now what about the certification of financial soundness? This is a very important concept. Whenever a bank issue a LC or BG, it is like the bank is saying that the customer is financially sound. It acts like a financial endorsement. So the bank name before become a certificate of trust. So bank name, it become a certificate of trust. For example, a seller accept the buyer order. So that is the point. For example, a seller is there, they accept the buyer order only because it is backed by a bank issue LC. So the master tip is that for borrower it is less cost, it is less cash, and it is more credibility. That is the biggest advantage for the borrower. See, formula flashcard is normal non-fund based limit cost less than the fund based facility, margin money, full credit support, give full credit support, low cost, low cash, high trust. These are the three peculiarities of this non-fund based limit. Question number 1: why are non-fund based limit less attractive to the borrower? Higher interest cost? No. Full cash outflow? No. Lesser cost than fund based limit? Exactly, C is correct. Next question: how do non-fund based limit help conserve borrower fund? No margin required. Actually, margin is required. Full loan disburse? No. Margin money give full credit support? Yes. This margin money give full credit support. That's why fund based limit help conserve borrower fund. Now let's come the risk. Let's come the risk part. Even though it is called non-fund based, risk is the same as the fund based lending. Obviously, it is cost. It is cheaper than the fund based limit, but the risk is the same. Because if the LC is if suppose LC is devolved, suppose if the LC is devolved, suppose is BG is invoked, suppose LC is devolved, BG is invoked, the bank have to pay the real money, right? So the rule is that LC devolvement, BG invocation, fund exposure. Very important thing. Suppose LC get devolved, BG get invoked, this led to fund exposure. For example, if the contractor failed to perform, BG is invoked and the bank will pay. So suppose contractor failed to perform, so bank pay when the BG is invoked due to non-performance. So this is a very important line for exam. Non-fund today can become fund tomorrow. Non-fund today can become fund tomorrow. Very, very important thing. This is the master tip, please remember. That suppose something is non-fund today, it will become a fund tomorrow. So LC devolvement, BG invocation, it become fund exposure. Suppose a contractor failed to perform, BG is invoked and the bank pay that. So that is why risk is there. Now, letter of credit. So it is a written promise by a bank to pay the seller on the behalf of the buyer. Written undertaking by a bank to pay seller on the behalf of the buyer. That is called, letter of credit. The most important rule in the LC is that bank always deals with the document. Bank never deals with the goods. So the payment depends on the document, not physical inspection. Right. So that means document is okay, bank will pay. When the seller submit correct shipping document, the bank make the payment. So bank pay seller on submission of the shipping document. This is a perfect example. Now what is the purpose of LC? Why do we need a letter of credit? See, because there is a time gap. There is a timing gap between what? Delivery of the goods and the payment of the money. So since there is a time gap between the payment and delivery, right? So LC solve this trust problem. So seller trusts the bank, buyer trusts the document. Formula is that buyer trusts document and seller trusts the bank. For example, in the international trade, buyer and seller may not know each other, but LC make the transaction safe. That is the role of LC. So the master tip is that in an LC, bank deal with the document, not the goods. This thing is very, very important. So next question we have, when does a non-fund based limit become a fund based? On sanction, no. On margin deposit, no. On LC devolvement and BG invocation, yes, correct. Right. So invocation convert exposure into actual fund dues. Now next question we have is that under a letter of credit, payment is made against physical good, buyer confirmation, document as per LC term, seller request. So payment is made against what? Obviously goods. No. Documents. Payment is as per the document, not the goods. Now, so please remember these key points, that it is much lower than the fund-based credit and lower operational complexity in the case of non-fund based, and credit support with minimum on fund, operational convenience, and bank certification. These are the key points regarding the LC. Now the next part is parties and role of the bank. See, let's first talk about the letter of credit and the country, right? So why do borrower prefer non-fund based limit? Why do borrower prefer it? Because they get big credit support with very little cost. Yes, they get big credit support with what? With little cost, right? So because of this reason, borrower prefer non-fund based limit. Right. In fund based loan, customer borrow cash, pay interest, uses on fund. But in the non-fund based limit, no cash is taken. Only a small margin is taken and bank give full support. So the rule is that a small margin deposit, right, give full credit support. Right. Alternative source of credit we have already discussed. Letter of credit. Now, letter of credit, I already told you, this is a written promise by the bank to pay the seller for the buyer. So you can see in the one line example they have given that exporter check political stability of buyer country before accepting the LC. Right. Bank never guarantee the quality of the good because bank obligation is limited to the document, not the goods. Quality dispute are buyer seller issue. Right. Bank have nothing to do with that. Document okay, goods is not okay, good okay. Is not equal to good okay, right? Bank will pay even if goods are defective, but the document comply. Because bank only deal with the document. So the next point we have, LC as a cash flow tool. LC help importer align payment with the sale proceed, and it improve the working capital management. You know about deferred payment LC? So the LC it provide the best cash flow, better cash flow. Deferred payment LC. Now parties to the letter of credit. The first party is the applicant, or you also call the buyer. Yes, just now I told you, LC as a cash flow. Which means by using deferred payment of LC, what happened, the buyer or the importer, right? Importer gets goods today. He gets the goods today, right? He sell the good in his country and he pay bank later. That's called deferred LC. Better cash flow it happen. So importer sell good first and then pay LC when due date is there. So the first party is the applicant or the buyer. Means the person who requests the bank to issue the LC. Person at whose request LC is issued is called the applicant or buyer. So what happened, buyer request, and on the request of the buyer, bank issues LC. Very important. For example, importer applying for LC to purchase machinery, right? Buyer request, bank issue LC. Importer is applying for LC to buy the machinery. What about beneficiary? He is called the seller. He is the party in whose favor the LC is issued. Right, LC is issued in the favor of a party, that's called beneficiary or the seller or the exporter. So the seller get paid after submitting the document. He receive payment on submission of the document. The rule is that document gets submitted, payment is received. For example, exporter receiving payment under letter of credit. What about the issuing bank? See, the issuing bank is the buyer bank that open the LC. The bank that issues LC at the buyer request. Most important point is that issuing bank has a primary responsibility to pay. Right? Who has the primary responsibility to pay? Issuing bank has the primary responsibility to honor the LC. So remember, issuing bank is the main obligor. Right? Who is the main obligor? Issuing bank is the main obligor. Right? For example, buyer bank issuing LC on the buyer request. Right? Buyer bank or issuing bank opening LC on the buyer request. Now let's understand what are the other bank involved in the LC. Till now we have covered the issuing bank, beneficiary, and export applicant or buyer, importer. Now we have advising bank also. They only inform the beneficiary about the LC, does not guarantee payment. They inform the beneficiary about the LC, right? So it does not guarantee payment. So the rule is that advise only, no payment obligation. Seller local bank, this is the seller local bank advising the LC. Exporter local bank, right? Advising LC received from the foreign bank. What about the negotiating bank? They check the document, pay the seller if the document are correct, right? And then later claim money from the issuing bank. So document means what? Shipping document, right? They take the shipping document from the exporter and see if it comply with the LC, and if it is comply, then they make the payment and later claim money from the issuing bank. So the rule is that confirming document is equal to payment plus reimbursement claim. For example, bank purchasing export bill under the LC. Then we have the accepting bank. So he accept the usance or term bill of exchange. The bank that accept a term bill of exchange. Very important concept. Acceptance create independent legal liability. Please remember, acceptance create independent liability. So the rule is that acceptance means legal commitment. For example, bank is accepting a 90-day usance bill and promising payment on due date. Due date. So suppose bank is accepting 90-day usance bill and promising payment of due date. So the master tip is that acceptance add one more bank guarantee to the LC. You can see they have mentioned acceptance add one more bank guarantee to the LC. So what about the confirming bank? Confirming bank add its own guarantee to the LC and they take the responsibility in addition to the issuing bank. They add own guarantee to the LC. So safety increases. So remember the formula: issuing bank plus confirming bank, double safety. For example, exporter demanding a confirmed LC when the buyer country is risky. So the formula flashcard is that LC payment against document only, not against the goods. Acceptance, independent bank liability. Question number 1. Which bank only advise the LC without payment obligation? The answer is advising bank. C number. Next question. Which bank added on guarantee to the LC? So that's called, confirming bank, right? Now in the LC transaction, bank responsibility is limited to a document submitted. That's all. Nothing to do with the quality of the goods. So remember the keyword that LC does not guarantee quality. Political and country risk matter here. Advising bank and confirming bank are different. Acceptance create independent liability and confirmed LC means maximum safety for the exporter. Then we have the DALC, or this is also called the usance letter of credit. See, in usance LC, payment is not made immediately. Payment is made at a future date and payment is made after a fixed period. That's called the usance period, right? After presentation of the document. So the exporter give time credit to the importer. So what exporter does, exporter gives time credit to the importer. So important point is that, the draft is drawn on the issuing bank or correspondent bank, not on the buyer directly. So this particular draft is drawn on the issuing bank or correspondent bank, not on the buyer. So remember the formula: payment date is equal to date of acceptance plus usance period. Hello. Friends, in usance LC, payment is not made immediately. Rather, payment is made after a fixed period, and that period is called, usance period. So payment is made after a fixed period, and that period is called, usance period. So exporter gives time credit to the importer. The important point is that the draft is drawn on the issuing bank or correspondent bank, not on the buyer directly, right? Draft is drawn on the issuing and correspondent bank. Very important point to note. So remember the formula: payment date or due date is equal to date of acceptance plus the usance period. For example, let's say documents are presented to friends, payment date is equal to date of acceptance plus the usance period, right? For example, suppose you submit the document today and LC says that 90-day usance period, right? So the payment will be made after 90 days, and this is called, UJANS LC. What is revocable letter of credit? So it means it can be cancelled or it can be amended anytime, right? No prior notice is required to the exporter, right? And that means exporter has no safety at all. That's why revocable letter of credit are rarely used. Why? Because the exporter has no safety at all, right? And mostly this is not accepted in the international trade, rarely used in the international trade, right? So the important exam rule is that if LC is not stated as revocable, it is treated like a irrevocable. Next point, for example, issuing bank cancel the LC suddenly without informing the exporter, right? So this is a kind of revocable LC. So issuing bank revoke the LC, right? They cancel the LC without informing exporter. Next category we have is the irrevocable letter of credit. You know what it means when I say irrevocable? It simply means that it cannot be cancelled, it cannot be amended freely, and consent of all the parties are required. Consent of all the parties is required. So who must agree? Now if we talk about all the parties, so who are the parties? See, party include the issuing bank. Issuing bank should be there, plus confirming bank should be there, plus beneficiary should be there. So consent of all these parties are required: issuing bank, confirming bank, beneficiary. So remember the rule. The rule is that amendment valid only with the consent of all the concerned party, right? This is a very important thing. Amendment valid only with the consent of the issuing bank plus confirming bank plus beneficiary. Because of this, exporter gets payment assurance, and this is the standard LC used in the trade. For example, exporter ship good confidently because LC is irrevocable. What is the confirmed letter of credit? See, confirmed LC means one more bank add it on guarantee. So when I say confirmed letter of credit, it means another bank added guarantee in addition to the issuing bank. So one more bank add it on guarantee in addition to the issuing bank. So exporter get double safety. Now he get double safety that his payment is assured because he is getting guarantee from the two banks. One is the issuing bank, other is the confirmed bank, right? One thing to remember is that confirmed LC is more expensive. Yes, cost is higher because one more bank is involved. So for example, the exporter demand confirmed LC when country risk is higher. When country risk higher, in that case confirmed LC is demanded. Back to back LC. See, an LC opened against the security of another LC. It is mostly used by trader or middleman. So how it works? So buyer open original LC in favor of the trader. Suppose there is a buyer, right? Or we call it importer. So importer open LC in favor of the trader, right? And trader open another LC in favor of the supplier. Trader open another LC in favor of the supplier. So remember the rule: original LC becomes security for the counter LC. So the LC between these two is called counter LC, and the LC between these two is called original LC. So this counter LC, so this original LC is the security for the counter LC. So trader use buyer LC to open LC in the favor of actual supplier. So what we have discussed so far, please remember, UJANS means time credit, revocable means no safety, irrevocable is a standard, confirm means double guarantee, and back to back means middleman finance, right? Please remember it. So formula flashcard, we have DALC, which means documentary acceptance LC, documents against acceptance, revocable LC, cannot be confirmed. So please remember it. Now let's apply the concept to some MCQs. In which LC does payment take place after a specified credit period? Site, revocable, UJANS, confirmed. Correct answer is UJANS. In UJANS LC, payment do not happen immediately. Rather, it takes some time. So that is called, it allows deferred payment after acceptance. This is the key point. Next question, which LC cannot be cancelled without consent of all the parties? So that's called revocable. So, see, revocable means can be cancelled. Irrevocable. Irrevocable means you have to take consent of all the party before cancelling it, right? So I hope this is clear till now. Now let's talk about the back-to-back LC. So what is this back-to-back LC concept? Let's make it clear. So friends, back-to-back LC is an LC that is open on the strength of another LC. So clearly they have mentioned it is an LC which is open on the strength of an existing LC. And it involves two LC at the same time. Friends, the content I am providing you is a part of our CCP comprehensive program. If you want to get access to the content in the form of PDF, videos, mock test, all at a single place, you can check out our CCP comprehensive program in the description section, or you can WhatsApp me on this particular number to get more detail. We are discussing the back-to-back LC. It is an LC that is open on the strength of another LC. Here, two LC exist at the same time, right? The first is called the main LC. Main LC is opened by the ultimate buyer in favor of the middleman. So ultimate buyer open in the favor of middleman. And back-to-back LC, this is opened by the middleman bank in the favor of actual manufacturer or supplier. So remember, main LC become the security for opening the second LC. Now who are the parties involved in back-to-back LC? First one is the ultimate buyer. Second one is the buyer's bank, which is the issuing bank of the main LC. Middleman and exporter, which is the first beneficiary. Exporter bank obviously is there. Actual manufacturer and supplier, second beneficiary, and supplier bank. So obviously you can see there are 6 parties. And practical working of this back-to-back LC is that middleman does not manufacture good himself. They only arrange the deal. He only arrange the deal. So what he do? The buyer open main LC in favor of the middleman. So the buyer or the importer, he open LC in the favor of middleman, right? And middleman bank offer back-to-back LC in the favor of manufacturer. So manufacturer ship good and submit the document. Middleman present the document under main LC. Payment received under main LC is used to reimburse the bank. So why back-to-back LC is required? Because when it is required? Actually, this is used when buyer is not willing to open transferable LC. Sometimes buyer is not willing to open a transferable LC. In that case, this back-to-back LC is used. And middlemen do not want to show supplier detail. They do not want to disclose the source of supply. In that case, this is used. And manufacturer want payment against the document. And beneficiary is sort of fund to pay the supplier. So in all these cases, basically back-to-back LC is used. So 2 separate LC are there. They are issued on the security of the main LC. Terms are almost same except amount, shipment date and price margin. And obviously bank higher risk for bank. So bank require good credit rating standard of the middleman. Then only they can go for it. Friends, the remaining portion will be covered in our paid course. If you want to get if we talk about the transferable letter of credit, so it is a kind of irrevocable LC, first point. And it clearly states that it is transferable, which means allowing the beneficiary to transfer it fully or partially to another party. So beneficiary can transfer this letter of credit to other party, right? So the golden rule for the exam is that if LC do not expressly mention transferable, it cannot be transferred. If the LC does not expressly mention transferable, it cannot be transferred. Who are the parties involved in the transferable letter of credit? Applicant, issuing bank, first beneficiary, transferring bank, and second beneficiary. So these are the 5 parties involved in the transferable LC. So now who can transfer the LC? Very, very important. Only the first beneficiary can transfer. And transfer happening through the nominated or transferring bank only. This is a very important point I am telling you. Lot of the questions are being asked every year that who can transfer the LC. So please remember the answer that only the first beneficiary can transfer, and that too through the nominated and transferring bank. So the key feature is that only one transfer is permitted. You cannot transfer it more than once. Second point, transfer may be full or transfer may be partial. Third point, first beneficiary is allowed to substitute his own invoice, to substitute his own draft, and to keep his margin. Unit price may be reduced. So unit price may be reduced to retain the margin. And one more thing is that shipment date, expiry date can be earlier, not later, right? So these are the few things that need to be kept in the mind regarding the transferable letter of credit. That only one transfer is permitted. Credit can be transferred fully or partially. And first beneficiary can substitute his own invoice, substitute his own draft. Unit price may be reduced to retain margin. Shipment date, expiry date can be earlier, not later. Now when it is used, when transferable LC is used, see, whenever the exporter act like a middleman, and whenever exporter has a limited credit facility, whenever exporter have a limited credit facility, so when it is used, when exporter act like a middleman, when exporter has limited credit facility, when buyer agree to the transferable LC, then it is to be used. So let's have a look at the difference between transferable and back-to-back LC. In the case of transferable LC, how many number of LC is there? Only one LC. In back-to-back, there are 2 separate LC. In transferable, the bank for risk is lower, right? Risk is lower for bank. And in the back-to-back LC, the risk is higher. In the third case, buyer must allow transfer, right? And in the actually we are talking to the context of buyer role in the transferable LC. So buyer must allow transfer In the back-to-back LC, buyer is not involved. And then transferable LC, it is cheaper. Right, what is cheaper? Actually, cost is quite cheaper, and back-to-back LC is costlier. So that's the difference between transferable and back-to-back LC. One LC, two separate LC. Risk is lower for the bank. In transferable, back-to-back, higher risk. Please remember, what is the rate clause letter of credit? See, rate clause LC is also an irrevocable LC, and it contains this allow the bank to give an advance to the exporter before the shipment. So bank can give advance to the exporter before the shipment. Right, earlier the special clause was written in reading, hence the name is reading. Earlier, this is a special clause was written in the reading, that's why this is called rate clause of letter of credit, which means basically, bank provide advance to the exporter before the shipment, pre-shipment advance. So purpose is very simple, to help the seller or to help the exporter buy raw material, manufacture goods and arrange shipment.